Are we at the peak of the economic cycle? Are we not? I'm going to talk 2019 outlook with JJ Kinahan, Chief Market Strategist at TD Ameritrade. To you, the chances that we're near the peak of the economic cycle?
I think much of it's going to depend on what happens when the president and President Xi of China meet at the G20 and what happens from the tariffs after that.
And at what point, obviously the president is a little bit unpredictable with trade. He said, I'm going to talk to Xi, and we don't know if that's actually going to lead to any progress. Are we expecting a little bit of volatility in 2019 just because of, again, trade?
Well, I think we're certainly expecting it through the rest of 2018 until we have some clarity there. 2019, even if we take away our own trade, you still have Brexit. You have the European Union that has some issues in terms of budgets. So I would find it hard. I would find it hard to believe that we don't return. The volatility tends to be mean reverting.
Wage growth, latest reading 3.1% increase in workers' pay. Seems pretty strong to me. So then I guess the question is, strong for now, when are we topping out? How do you read that number?
Well, I think that, it's been a slow trend on the way up. We still, I think many have wanted inflation, so to speak, haven't necessarily gotten the inflationary numbers they wanted, but the biggest contributor to inflation being crude oil. And crude oil is, I should say energy in general, but if you look at crude oil, it's kind of had some troubles getting going. So we'll see what happens, but right now, I mean, we have this incredible job-creating machine, and I think many of us have been waiting for the last 6 or 8 months to see when there would be some wage pressure. So this month, I thought, was one of the first times that we've truly seen wage pressure. So
in that case, would you say that are you comfortable with the pace of Fed tightening and even through 2019?
Well, I think certainly through December, it's already built into the market. I would say I am, and I think a lot of it will. I think they're in the same mode we all are. Let's wait and see what happens here over the next 2 months before we make any definitives for next year.
And if it's a little bit of wait and see, do you see some investors going into cash a little bit before they make a move?
I think what's interesting is I look at what our clients have done, and they've sold some things that have gone up significantly over the last year or two, and done some targeted buying, so to speak. When stocks get hit on earnings or whatever it may be, but stocks they still believe in longer term, they're not afraid to go in and buy them, and I would think that pattern will continue overall in the market. The problem for the next 2 months, you may see a little bit of a relaxation of that, only because people are trying to figure out where we go, and a lot of the fund managers have had good years. They don't necessarily want to risk it in the last 2 months of the year, so they'll get some more clarity, I think, before they come in with bigger cash.
Okay. Now, if investors, if you're a conservative investor and you want to pivot into safer assets, maybe you are not so optimistic on the economy going, through 2018 and then into 2019, when do you go into bonds? Because if you expect the Fed to, to continue to raise rates for the foreseeable future, you don't want that interest rate risk now. I mean, what do you do?
Well, we've seen some people start to nibble at bonds quite a bit more over the last few weeks, and again, I think it's interesting because normally our clients are bigger buyers of high-yielding stocks, the AT&Ts, the Exxons, et cetera, of the world. What's interesting is our IMX coming out today will show that the Exxon was actually a sell, but the stock itself did fairly well. So, it's kind of interesting that people sold that last month. And AT&T did not show up on abnormal activity, and our clients have been buyers of that over the last few months.
Going into 2018 and then again into 2019, to you, what's a more conservative play, I guess, in stocks, and then a more aggressive play in stocks?
Well, I think that aggressive plays right now will be, as we speak, might be some of the chip makers, because A, a lot of them have had really good years, and B, part of it being we don't know what's going to happen with tariffs. This may turn out to be a conservative investment at the end of the month. Right now, it seemed to be aggressive to be in there. Conservative investments, defense is always conservative, and defense sector seems to be performing fairly well. We'll see if it can continue into 2019, but a lot of those also pay some dividends.
I got a quick question. If you do look at financials, I noticed Morgan Stanley has a PE ratio right now of 10. That's below than I think all of its peers. Is that attractive to you?
Well, I think anytime you have a good sector and you like the sector overall, and the stock that's performing in a lot, if you look at where they're performing on their trading end of the business. So if you believe that trading is going to continue to do well, that's a stock with its PE that would be attractive.
And I want to tie some things together now. So let's take a scenario where the Republicans sweep. You have tax plan 2.0. That may not be great for stocks, but you do have reduced taxes and maybe a little bit more purchasing power across the economy. Does that force the Fed's hand a little bit to continue to raise rates?
Well, I think a lot of it's on that's a bit speculative, but with all that, I would say that if the economy continues to improve, the Fed has to watch inflation.
And the last thing I want to talk about, and this is big for TD Ameritrade, tell people what exactly the IMX is and why it's so important.
Sure, the IMX measures our clients' activity, and so their exposure to the market overall. It takes into account not only stocks, but options positions, bond positions, weighs everything to volatility. And so with that, it will show our clients' true exposure to the market. What we saw in October, it was the first month in 6 months that our clients took less exposure to the market overall. With that, it was only 2% less exposure, I think, really sort of reflecting what's going on in the market right now. A lot of ups and downs. And so with that, our clients buying some of the stocks that got beaten up a bit, the Apples, the Amazons of the world, selling some stocks that may have had a little bit more of a pop, or stocks that, have had good years and maybe our clients have held for a while, like Facebook. Twitter's had a great year. Those were sells this month. So it's an index that I think is really interesting, and the reason we started it only measures clients who have interacted with the market at least once in a month. The reason we started it is we got tired of hearing that retail is dumb money. We saw what they were doing every single day. People who engage with the market at least once a month tend to make actually pretty good decisions, and as we've seen if you compare that to the S&P 500. Now, if someone plans their vacation longer than they plan their retirement, they're probably not going to make good decisions. So that might not be the smartest money, but those people who take time to educate themselves and actually get involved with the market tend to make really good decisions.
Yeah, and this may not be something that you have off the top of your head, but if you do, if you look at institutional money versus retail money, do you see any stat that tells you that retail money moves markets a little bit more than people actually think?
I would say that the amount that retail contributes to the daily volume in equities and options and futures would probably surprise many people. It's a much bigger number than I think people give it credit for.
Yeah, and the last thing, top 3 takeaways for you when educating clients towards the end of 2018 and then going into 2019?
Well, I think the biggest, a couple of messages are timeless. And the biggest timeless message is know your time frame. I see it too often where people buy something, they say, I'm holding it for a year or whatever, and then after a move in a week, they're like, I got to get out. And that is absolutely number one. Number 2 is trade smaller than you think. And I know I'm at a brokerage firm and I should be, no, buy everything. No, but it's truly, use movement as your friend, not your enemy. If you have 500 shares to buy and they only buy 200, if we go down, it's an opportunity to buy more at a better price. If you buy all 500 at one price and we go down, too often people are like, oh my God, I got to get out. And they put themselves in a bad situation. And then the last thing, particularly as we head into the end of 2018, into 2019, we're returning to a normal volatility environment. So if you're not used to these types of movements, you may want to just observe for a little while, get used to the flow. And it really, you have to be comfortable with what's going on. If you're not comfortable, just wait. There's always going to be opportunity.
So maybe in that case, investors aren't driven as crazy as they've been recently and can just focus on going to work and being a normal person.
Well, yeah, and like I said, if you know your time frame, if you're a trader, this is the greatest environment. If you're a trading type client, we're back and forth. If you're a longer term investment, it's a fine environment. You just have to ignore some of the daily noise.
Gotcha. JJ, thanks so much.
Jake.
Really appreciate it. All right.